Happy New Year, everybody! As we enter 2026, this is an amazing opportunity to look forward, look ahead to see what the year might uncover. And with that, I would like to bring my 2026 real estate predictions. Of course, I'm not psychic, so these are my educated guesses of what I think will happen this year based on my experience, my knowledge as a full time real estate broker, but also based on current data. Of course, world events can change, policies can change, and that will affect what happens. But based on the current data and my experience, this is what I think will happen this year. So let's get right into it. So, number one, I think the active listings will continue to remain very high. So, last year we broke records of having very elevated inventory. I think we even surpassed 30,000 at one point. I think these active listings will continue to remain high. I think we're going to get a lot of new listings that hit the market this spring. The reason why I think that is because there's a lot of pent up supply right now. There's been so many people that have been waiting for the market to recover so that they can put their house up on the market. But you can only wait and hold for so long. And so I think some people will be forced to finally put their house on the market and, settle for today's prices. I think that's happening, as well as other people might just believe that the end is not in sight, that the recovery period is going to take a little bit longer than they expected, and that prices might not even recover until next year. And so they just want to kind of bite the bullet and get their house on the market this year. With that, I also think that power of sales will continue to increase. So this is a chart by Valerie on power of sales, and this is dating back since 2023. And as you could see, are on a upswing of power sales, and I think that this trend is going to continue. I think we're going to continue climbing throughout the year. Let's talk interest rates. So as you can see here, this is the major banks' forecast for where they believe the policy rate set by the Bank of Canada will be by the end of the year. So we're currently at 2.25, and you could see RBC believes by the end of the year it's going to be 1% higher. And TD and BMO believe it's going to be the same, with Scotiabank and NBC in between. I'm actually going to go against the grain here, and I think interest rates are actually going to probably remain the same for the first half, but by the second half, I think we're actually going to cut by 0.25%. And the reason I say that is because our GDP growth has been really bad, and I think everybody can agree that we feel like we've been in a recession, even though technically one has not been called, because technically a recession is when you've experienced two consecutive negative GDP growth. And so going over here, you could see since 2023, since the end of 2024, but also majorly in 2025, we've experienced a lot of negative growth. But September, we actually experienced a little bit of an increase in GDP growth. But if it wasn't for this month, we would actually technically be in a recession. And if you actually uncover this data, you would notice that the reason why that we actually increase our GDP is largely because of the government spending in defense. And so if you kind of strip away the government spending, like, we would definitely be in a recession, and the government can only prop up the economy for so long. And so I think at some point this year, we're going to slip into an actual recession, and then the Bank of Canada is going to be forced to, drop interest rates to supplement that. Okay, let's jump into rent. So rent prices have gone down over the last 12 to 18 months, and I believe they are going to continue to decline. And the reason is because the majority of the GTA rental pool is actually temporary residents. So those with work permits and international students. And based on this chart here, the target for the government is actually to decrease these temporary residents by 40%. So if we have less temporary residents, that means there's going to be greater supply, which obviously puts a downward pressure on prices. And this is also happening simultaneously with 17,000 new condos hitting the market this year. And I think we saw over 30,000 last year that are still, a lot of them are still vacant. And so, you know, all this supply hitting the market and a lot of the demand leaving the country simultaneously is going to put downward pressure on rental prices. All right, so let's jump into sales. So I think sales are going to increase from this year compared to last, and I think it's going to be primarily driven by first-time home buyers. So investors are mainly out because it's challenging to cash flow in Toronto in the GTA on a condo. The reason being, I just mentioned that rental prices are continuing to decline. And so even though prices have softened, it is still challenging to cash flow on a lot of these condos. There are some opportunities available for sure, but they are far and few in between. And so the biggest segment, sorry, is going to be first time home buyers. And they are driven by interest rates, which we have seen are going to likely kind of cruise and remain here, um, as well as certainty in their jobs. And so last year, with the tariffs and all the uncertainty with that, a lot of first time home buyers were unsure of their job. They didn't have stability in that. And now, as time kind of elapses and there's that cushion of time, I believe that first time home buyers will feel a little bit more certain and realize that this is a great opportunity to buy at low prices at a good interest rate. So I think we're going to see an influx of sales from that segment specifically, and that's going to create a year over year increase in sales. Now, when I say it's going to be an increase of sales since last year, I mean, it's not really a huge victory because last year was one of the lowest sales we've seen since the 90s, the late 90s. And so, although official data is not yet out, we are going to be having, I think, 60 to 65,000 in sales for last year. And so, to beat that, like I mentioned, it's not going to be a massive victory. So, I think it's a really easy win here. But I do think we are going to do more than that. Nothing crazy. I think we're still going to be below the 10-year average, but I think things are going to start to pick up. And now for the one that you've all been waiting for, I'm sure, is prices. So this one's going to be kind of boring, but I think prices are basically going to remain unchanged. They're going to be plateaued. I think we're going to continue to see that negative year over year decline that we've seen over the last few months for the first few months, because last year, around this time, prices were actually starting to creep up right before the whole tariff thing begun with Trump. But as we kind of move past March, I think it's going to be very much a plus one to minus one change in prices overall. What I do think is going to happen though is that the gap between condo prices and freehold prices will start to widen even more, and it might break some records and be some of the largest gaps we've seen in history. I think the condo market is going to continue to soften, especially those investor type condos, those shoe boxes with poor layouts, no parking, small square footage. And I think that since we're not building freehold per se, that the demand for them still exists. And so the price drops on that will actually be completely gone. If not, prices will plateau or maybe even increase in some segments where there's not a lot of supplies. And so I think that gap between freehold and condo prices is gonna widen some more this year. So is 2026 a bad year? I would say no, it's not. I know the data that I showed with you kind of sounds negative, but I think it's also very realistic. And I think it's going to be the start of our recovery. So I think this year, like I mentioned, is going to be kind of boring. It's going to be very much a plateau, but I think it's going to really set the foundation for the recovery over the next few years, where we're going to start seeing price appreciation, more sales growth over 2027 to 2030. And so this will be a very foundational, fundamental year. To my investors, the easy money we've seen the last decade is gone, but you can still win in this market by leveraging two things. So, number one is timing. So, this will be probably the last remaining period where you can get really good prices, discounted prices for a while. Also, this is great for first time home buyers because it might be very challenging to become a first time home buyer for the years to come, as we are no longer really building new properties, not condos, not freehold. And so over time, we will extinguish our supply. And the second way you can win is by cash flowing. So, gone are the days where you can buy a property and you can count on the appreciation to take you forth over the next few years. You need to cash flow on these properties or else you will be in trouble. Overall, the GTA market isn't going anywhere, but the way you win has changed forever. 2026 isn't for the faint hearted, but for the disciplined investor and the well informed buyer, it is a year of massive opportunity. I'm Marissa Correa, and if you want access to the discounted properties that I'm seeing right now, send me a DM or click the link in the description. I'll see you on the next video.